Today I would like to analyze DHL Group, also known as Deutsche Post. For me, it's one of the most undervalued stocks right now. We can see here they have a PE ratio around 12.58, which is very low, and they have a high dividend yield around 5.45%, and they're gonna pay this dividend in May, so this is looking very good. When we see the stock price, we are down around 8% in the 5 years, and in 1 year we are down close to 30%. So from the stock price, it looks cheap, and we're gonna take a look at the financials to find out if the stock is undervalued right now. The first thing we are looking for is revenue growth in the last 5 years, because we want to invest in a growing business and not a declining business. We can see here in 2019 it was around 63 billion. Then we have a 5% increase in 2020. Then we have a very strong increase around 22% in 2021, mostly because of COVID. Then we have a 15% increase again, which is very good actually. And then in 2023, we have a 13% decline. Of course, we don't like to see that, but we also have to understand that the revenue did grow a lot before. So it's quite normal that we have a decline right now, I would say. And we are still up over the last 5 years. So it's a check here for me. The next thing we are looking for is free cash flow growth in the last 5 years. This is a very important number because the company used the free cash flow to pay back the debt and also to pay the dividend. So we want to see that grow over the last 5 years. We can see here in 2019, it was around 2 billion. Then we have a strong increase around 124%. Then we have an increase again, 35%, 13%. And now we have a decline around 17% in 2023, but again it's still strong, up from around 2 billion to around 5.4 billion. So it's a growth in the last 5 years, and it's a check here as well. Now we would like to see the free cash flow yield over 4%. This also tells us about the valuation of this company. So if the free cash flow yield is under 4%, it could mean the company is overvalued. So what we're going to do now is we're going to take the free cash flow in 2023. So it's around 5.42. And then we're going to divide it with the market cap around 39.72. And then we're going to get the free cash flow yield. So the free cash flow yield is around 13%. So to be accurate, is around 13.64%. So this is incredible free cash flow yield. It's over 4%, and it could already mean this company is very undervalued right now. Now we're going to take a look at the balance sheet as well. So we would like to see the debt to free cash flow ratio under 5. This means the company can pay back the debt with the free cash flow in under 5 years. This is a very important number because if a company has too much debt and cannot repay it, it could face bankruptcy. So we don't like to see that. So what we're going to do now is we're going to take a look at the debt. We can see here the short-term debt around 3.23. And then we're going to take a look at the long-term debt as well. So for me, actually, the number that makes more sense is this, 5.78, because this is a long-term debt excluded capitalized leases. So I think it makes more sense to use this number than this. So we're gonna make it plus 5.78. And then we're gonna divide this with the free cash flow. The free cash flow was around 5.42. So the number we get around 1.66. So it's mean in a little bit over 1 year we can repay the debt with our free cash flow. So it's a check here. And even if we would use a higher number, the 17, I think it still would be a good number. Let's calculate it quickly. So if we use the 17, it would be around 6.36. So it would be higher, but I think it makes more sense to use this number, the 5.78. So it's a check here for me. The next thing we are looking for is shares outstanding decrease. This means the company buy back their own shares. And we would like to see that, especially if a company is undervalued, we would like to see them buy back their own shares. This can increase the stock price because there are less shares outstanding. We can see here DHL did buy back shares many years. It started in 2020, then it increased a little bit, but then again 2022 they bought shares again, and then 2023 and 2024 around 2%, which is a very good number. So this can really help the stock price to increase, and it's a check here as well. I would like to give my conclusion about this company. So let's start with a positive. They have a strong business. They benefit a lot from the e-commerce growth, and they are the very big player international. They have the revenue growth in the last 5 years. They also have the free cash flow growth in the last 5 years. They have a very high free cash flow yield, which could mean that they are undervalued right now. They also have a high dividend yield, over 5%. So for me, the only negative in this company right now would be the relying on the oil price. So if the oil price increase a lot, this could mean the company have less profit. So this is the only danger in my eyes. Maybe some competition as well, but I think the main point here is the oil price. So if the oil price not increase so much, I think they can have a lot of profit in the future.